let's say if you're buying a house for $500,000 and the appraisal comes back at $490,000. I guarantee you 99% of people will say, oh, you got to bring that extra $10,000 to the table. That is not correct, you guys. It is not correct. If you waive the appraisal on your new home offer and the home does not appraise, that does not necessarily mean you have to bring those additional funds to the closing table. Now, before anyone says anything, you know your girl is bringing receipts. I have a clear example that I'm going to throw up on the screen for you guys. But let me tell you that this guideline, this concept of the appraisal gap, waiving the appraisal, or what if the appraisal falls short, this concept is one of the most commonly misunderstood concepts in the mortgage process. And I gotta tell you, it is very dangerous, because not understanding this now before you start submitting offers means that you may submit a weak offer, which means you're gonna miss out on the home that you love. So do not be scared of the whole, oh, if the appraisal falls short thing, because I'm about to give you all these juicy details. But before I give you guys all the scoop, we gotta do a quick recap on what the going on in the real estate market right now, because let me tell you, in a lot of areas like New Jersey, the real estate market is hot right now. They think they're doing something with these 6-7% rates. Nobody's scared of them, because there's still bidding wars. People are still buying homes with cash. People are still coming with guns blazing. So the most recent Consumer Price Index report just dropped some good news that the rate of inflation is improving. Now, the CPI report is a monthly report issued by the Department of Labor, and it basically shows you how many goods and services can one purchase with the dollar. Now, how this ties with mortgage rates is the Fed uses the CPI report to basically calibrate their fiscal policy, aka get us back to where we need to be. As you guys know, the Fed has been increasing their Fed rate to combat inflation, but looky here, if inflation is coming down, then the Fed needs to come down too. And basically, historically, so when the CPI index improves, mortgage rates improve. So the biggest takeaway with all of this is, where are we today? Where are we headed? We're probably headed to lower mortgage rates, which means more buyers, more demand, higher prices. Higher prices mean stronger offers. So probably in your stronger offer is going to be something about an appraisal. Let me show you guys exactly what I am talking about in my snapshot. And first, let's quickly define what is an appraisal. An appraisal is a home inspection. It is absolutely required by the bank, because the bank wants to make sure that the home is worth what everyone says it is worth. Why? Because the bank can only lend on the appraised value. This is where the appraisal gap or the appraisal shortfall comes into play. Say if you're buying a house for $500,000 and the appraisal comes back at $490,000. I guarantee you 99% of people will say, oh, you got to bring that extra $10,000 to the table. That is not correct, you guys. Why? Because even if an appraisal may fall short compared to your contract price, your loan is based on your loan to value, which is everybody's situation is different. So, for example, let's say this house is $600,000 and you're someone who puts down 20%. And the appraisal comes back at $600,000. Okay, your down payment is $120,000, your loan amount is $480,000. You only have to bring that $120,000 that you planned on. So you're rocking. Or let's say you want to bring a 20% down payment. Your purchase price is $600,000, but the appraisal comes back at $575,000. But you're like, no, I still want to do a 20% down payment. That is a scenario where you will need to bring that extra $25,000 because you want an 80 LTV. You're like, nope, I want 20% equity in my house when I close. Okay, you're going to bring that extra cash. So now your total cash out of pocket is the $140,000. Let's say this same person is like, okay, I absolutely do not want to bring more than $120,000 no matter what. And let's say the appraisal comes in at the $575,000. Okay, Mr. or Mrs. Homebuyer, the appraisal fell short, but guess what? We can just reduce your down payment amount, and you could put less down to account for the appraisal shortfall. And so instead of putting down 20%, you're going to put down 15%. And now you're only bringing a total amount of $111,000. The same thing, if the house only appraised for $550,000, you still have wiggle room. You initially wanted to put 20% down, but we have to account for the appraisal shortfall. But you're still bringing less money out of pocket. Now you're going to have less quote unquote equity, okay? But your out of pocket is still going to be less than the 120. You're not bringing, the appraisal fell short $50,000. You're not bringing 120 plus $50,000. You're only going to bring that 105. Let's go to the 10% real quick. A lot of people do a 10% down payment for sure. Let's say if it comes in short at $575, the appraisal, and you're like, you know what? I don't want to bring that extra money. Okay, great. Well, we can do a 5% down payment conventional loan, Miss Homebuyer. Oh, okay. Reduce your down payment to 5% down to allow for that appraisal shortfall. Now you're only bringing $53,000. Now I know someone out there is like, well, but now you're gonna have less equity because you're putting less down payment than your initial plans. There's no rule book that says, oh, this house is absolutely worth $600,000. Guarantee if someone found it in their soul, so if someone came along and saw a house that you were willing to pay $600,000, but for whatever reason they're willing to pay $700,000, despite the appraisal and whatever else, that is their price that they want to pay. What I'm saying is, if you love the house that much, you should just buy it. Real estate is a long-term game anyway. I'm just saying, do not get caught up in, oh, I don't want to pay more than appraised value, because who said the appraiser is even correct? There are homes that just 6 months ago that were $490, they are $550 just 6 months later. Why? Because everyone sees the value. Whether it appraised or not, people are still pushing it up and up and up. Let's go to the 5% down payment scenario, because this is the one that definitely gets people. Of course, if it appraises, you're bringing $30,000 out of pocket. If the appraisal comes in at $575, the bank can only lend on whichever is less, contract price or the appraised value. To maintain the 95 LTV or the 5% down payment on the $575, we can only lend you $546,250, which means the difference between the $600 and the $546, you will have to bring to the table. I know that may have been a lot of information to digest, but the biggest takeaway is that when you have more skin in the game, aka a larger down payment, and if the appraisal falls short, if the appraisal blows up, whatever may have you, you have the flexibility to adjust, reduce your down payment to make up for that shortfall, so then your total out of pocket is not increasing. And then for those who are doing a 5% down payment, a 3.5% down payment, or a 3% down payment, or a 0% down payment, if the appraisal falls short, you don't have as much wiggle room in reducing your down payment to make up for the appraisal shortfall. That's when you're having to bring additional money to the table. So, like I said, I know it's a lot of details, but you guys know I'm an educator by heart. And there's proof in the numbers don't lie. And of course, if you found value in this video, please share it with a friend, hit the like or subscribe button. And until next time, I'll holler at you guys later.